Have you ever seen a crypto coin with a funny dog picture on it skyrocket 1,000% in a day and felt a knot in your stomach? That little voice whispering, "What if I had just put $100 in? I'd be rich." That, my friends, is FOMO, the fear of missing out. And while it exists in all financial markets, it seems to be on steroids in the world of crypto. But why? Why does a digital coin named after a meme trigger more panic buying than a share in a company like Apple or Google? Today, we read diving deep into the psychology behind why crypto FOMO hits us so much harder than stock market FOMO. It's not just about greed. It's a fascinating mix of human nature, technology, and a market that never ever sleeps. First, let's talk about the sheer speed and volatility of crypto. The stock market, for the most part, is a relatively calm ocean. It has its storms for sure, but a 5% move in a single day for a major stock is considered huge news. Now look at crypto. A 20%, 50%, or even 100% move in 24 hours isn't just possible. It's practically a weekly occurrence for some coins. Our brains are wired to react strongly to rapid, dramatic changes. This hypervolatility creates a constant sense of urgency. The thought process isn't, "I should invest for my retirement in 20 years. It's, "This coin is up 40% in the last hour. If I don't buy right now, I might miss the next 40%. This speed compresses the decision-making window, short-circuiting our rational, long-term thinking and activating our primal, reactive instincts. The stock market moves in chapters. The crypto market moves in sentences. It's just too fast to ignore. Another huge factor is the 24/7 global nature of the crypto market. The New York Stock Exchange opens at 9:30 a.m. and closes at 4 p.m. Eastern Time. It closes on weekends and holidays. This gives you time to breathe, to disconnect, to research, and to think without the constant pressure of price movements. The crypto market, on the other hand, is a relentless, sleepless beast. It's always open, somewhere in the world. When you're sleeping, traders in Asia are active. When you're at work, Europe is online. This constant activity, amplified by social media and price alert apps on our phones, creates a never-ending stream of information and potential opportunities. It's like trying to relax in a room where a loud alarm could go off at any second. You're never truly off the clock, which breeds a chronic state of anxiety and the feeling that you could be missing out at any given moment. This perpetual market cycle is a perfect breeding ground for FOMO to fester. Then there's the power of narrative and community. Stock investing is often a solitary, data-driven activity. You read earnings reports, analyze price-to-earnings ratios, and listen to analyst calls. It can be a bit dry. Crypto, however, is built on stories, memes, and vibrant, almost cult-like online communities. You don't just buy a cryptocurrency, you join a movement. You become part of the Doge Army or the SHIB Army. These communities on platforms like Twitter, Reddit, and Discord create powerful social proof. When you see thousands of people passionately evangelizing a coin, sharing memes about going to the moon, and posting screenshots of their massive gains, it creates an incredibly strong psychological pull. This isn't just about financial data, it's about belonging. Humans are social creatures. We have a deep-seated desire to be part of the in-group. Seeing a community get rich together without you is a far more potent trigger for FOMO than reading that a mutual fund had a good quarter. The lack of traditional gatekeepers and fundamentals also plays a massive role. To buy stocks, you typically need a brokerage account, which involves a certain level of regulation and process. The companies themselves are valued based on tangible metrics like revenue, profit, assets, and cash flow. You can analyze a company like Microsoft and arrive at a reasonable valuation. But how do you value a coin created as a joke? Or a token for a decentralized project that doesn't have any revenue yet? The absence of these traditional valuation models creates a vacuum that gets filled by hype, speculation, and narrative. When there are no fundamentals to anchor the price becomes whatever people are willing to pay for it. This makes the potential upside seem limitless. An analyst won't predict that Tesla stock will go up 10,000% next month, but you'll easily find someone on YouTube claiming a new altcoin will. This anything is possible atmosphere is the jet fuel for extreme FOMO. Let's also consider accessibility and the illusion of a level playing field. Getting into crypto is, in many ways, easier than ever. You can download an app, connect your bank account, and buy a fraction of a coin within minutes. This low barrier to entry makes it feel incredibly accessible to the average person. It fosters a David versus Goliath narrative, where retail investors believe they can get in on the ground floor of the next big thing before Wall Street and the institutional giants do. Stocks, especially IPOs, often feel like a game rigged for the insiders. Crypto, with its decentralized ethos, presents itself as a more democratic opportunity. This feeling of being an early adopter in a revolutionary technology is a powerful motivator. The FOMO isn't just about missing out on money. It is about missing out on being part of a financial revolution and getting in before the suits take over. The media and social media influencers amplify all of this to an insane degree. Financial news about stocks is usually quite measured. But crypto coverage is all about extremes. Headlines scream about teenage millionaires, life-changing gains, and dramatic crashes. Influencers with millions of followers flex their Lamborghinis and luxury lifestyles, attributing it all to their crypto investments. This creates a highly distorted perception of reality. It filters out all the stories of people losing their life savings and exclusively highlights the lottery-like wins. When your social media feed is a constant highlight reel of other people's success, it's almost impossible not to feel like you're being left behind. This curated reality manufactures FOMO on an industrial scale, making it seem like everyone but you is getting rich quick. Finally, there's the psychological concept of regret aversion. Studies by psychologists like Daniel Kahneman have shown that the pain of a loss is felt about twice as powerfully as the pleasure of an equivalent gain. FOMO is essentially preemptive regret. You're not just afraid of missing an opportunity. You're afraid of the crushing regret you'll feel if that opportunity turns out to be huge and you did nothing. With stocks, the potential regret is manageable. If you miss a 20% gain on a stock, it stings, but you move on. But with crypto, the stories are about 1000x or 10,000x gains. The potential regret is life-altering. The thought of telling yourself in 5 years, I could have turned $500 into $500,000, but I didn't, is so terrifying that it compels people to make irrational decisions in the present just to avoid that possible future pain. The sheer scale of potential crypto gains magnifies the anticipated regret, and therefore, the FOMO. So when you combine a market that moves at lightning speed, never sleeps, is driven by powerful social narratives instead of fundamentals, feels accessible to everyone, and is amplified by a hype-driven media machine, you get the perfect storm for psychological manipulation. Crypto FOMO is more potent than stock FOMO because it taps into our most primal instincts: social belonging, fear of regret, and the allure of a lottery ticket that could change our lives overnight. Understanding these forces doesn't mean you should avoid crypto, but it does mean you should be incredibly aware of them. The best defense against a FOMO is a plan. Do your own research, invest only what you can truly afford to lose, and try to separate the hype from the reality. Remember, the loudest voices are often not the wisest. Thanks for watching. And if you found this breakdown helpful, be sure to like, subscribe, and hit that notification bell for more deep dives into the psychology of finance. See you in the next video.